Very good morning, friends. So I hope your revision is going good. And we are on the last phase of Index 103. And just to remind you what we have covered so far and what we're going to do today in terms of 103, that is business combination. So we identified at the very initial that there are basically three kinds of accounting. One is called acquisition accounting. The other one is what we call a reverse acquisition. And the third one is the common control transactions. Our focus has been on the acquisition accounting so far. So we have covered the 7 steps which are required for acquisition accounting. And just to remind you, when you look at the concept of acquisition accounting or a case of reverse acquisition, it is a transaction which is with unrelated parties. Well, we don't deny the possibility of a related party transactions being covered under acquisition accounting or under reverse acquisition. But generally, I'm using the word carefully, generally, you will see that related party transactions would fall under the ambit of a common control transaction. But let's say the parameters of the common control transactions is not met, even though the transaction is with the related parties, then it comes under acquisition or a reverse acquisition accounting. So we've covered the aspect of acquisition accounting, all the 7 steps in detail, looking at questions within each steps as well. Now my focus today is going to be on reverse acquisition, that is 1, addressed by Appendix B of the standard. Then common control transactions, that is addressed by Appendix C of the standard. And as I said, we're going to do a little comprehensive question as well. There is one very comprehensive question in the study material as well, which takes care of the aspect of acquisition accounting, not reverse acquisition, not the case of common control. But that's a huge question, but I think I just want to discuss at least certain aspects of that particular question, because I think that is devoted quite well, typically to the concept of, I can say, step number 3, making a list of net assets. And there is another concept also which discusses the concept of what we call measurement period concept, which of course I've not given you a rough view. We'll talk of that agenda in that question itself. So let's begin the journey in terms of reverse acquisition. So as usual, we're going to first take a little quick revision of the concepts and then come to the attacking of the question. So let's talk in terms of the second category of accounting, and that is called reverse acquisition accounting. Now, as far as reverse acquisition accounting is concerned, I think already said that earlier, that it is basically your step number 2. When you look at the identification of the accounting acquirer, at that particular stage, you come to know that whether it is a case of a reverse acquisition or not. So I would say the focus point in terms of identifying whether it is a reverse acquisition or not is basically going to be a step number 2. So I think one thing which can be said point blank at this stage, you already know that there are 2 kinds of, situations when we look at accounting. A new company is created or a new company is not created. So I think if I look at the possibilities when a reverse acquisition can occur, so we can say the possibility number 1 is when you say a new company is not created. When a new company is not created and your purchase consideration is mainly in terms of shares, then there could be a possibility of a reverse acquisition. You need to calculate a pre and a post percentage business combination. So in this particular case, you will compare the pre-business combination percentage versus the post-business combination percentage, and then identify that there could be a possibility of a reverse acquisition. So in this particular case, it's not a sure shot, but there is, a possibility. There is a possibility that it may turn out to be a reverse acquisition when your percentage falls below the control limit. The second situation is when a new company is created. When a new company is created and the purchase consideration is again mainly in terms of shares. When it is mainly in terms of shares, in this particular case, you don't need to evaluate anything. It will absolutely be a case of a reverse acquisition because one of the, you can say, acquiree, one of the existing companies, undoubtedly is going to be a accounting acquirer. So in this case, we can outrightly say that this will, of course, be a case of reverse acquisition. So what we're going to do, we are going to do two questions on this area. I'll do one particular question where there is no new company created, where we check the percentages and identify is a reverse acquisition or not. And then we'll also do another question as well, where a new company is created and undoubtedly it becomes a case of reverse acquisition. Right, so that was just an input in terms of identifying the reverse acquisition. The rest of the inputs in terms of how the purchase consideration is computed, I think those nitty-gritties will revise as we go to the question. Right, so far so good. So I think let's share a question to you. So this is a question which is there in the study material as well. I hope this is perfectly visible. I think I've increased the font quite a bit. And let me also zoom this out as well. Okay, I hope you can see it clearly. The visibility is fine. So let's come back and let's first read the question number 5. So first I am given the inputs. It says on 30th September X1, entity A issues 2.5 shares in exchange for each ordinary share of B. All the shareholders of B exchange the shares in entity B. Therefore, A issues 150 ordinary shares in exchange for all the 60 ordinary shares of B. So that means it is a complete acquisition where all the shareholders of B accepted the exchange ratio 2.5. So 60 into 2.5, that makes it 150. Then he says the fair value of each ordinary share of B on 30th September is 40. So value of B is 40. And the quoted market price of entities A ordinary share on that date is 16. So you're given the fair value of A, that is 16, as well as B, that is 40. I'm just thinking that if you consider the 40 rupees value divided by 16, it comes to 2.5. I'm just thinking that does this mean that the exchange ratio is decided on the basis of the market value, that is the fair value? What is your insights on that? So we're given the exchange ratio is 2.5. When you divide the market price 40 by 16, you get 2.5. So do you think this is based on the fair value market prices? Undoubtedly, yes. I think I didn't get any inputs on that, but yes, undoubtedly, yes. Okay, then it says the fair value of entities A. The fair value of entities A assets and liabilities are given. Now, there is one particular question which should definitely come to your mind as you read this particular question. The question started on the note that A is acquiring the shares from the shareholders of B, which means on the very apparent front, A is supposed to be the acquirer, of course, the legal acquirer. But as you read on, it tells you that the fair value of the assets of A and B is given. Now, we make a list of net assets of the accounting acquiree. So suddenly when it tells you the fair value of the net assets of A, I think the point should come to your mind that this is a reverse acquisition. Because when he gives you the fair value of the legal acquirer, I think that is also indicating that, the net assets of a fair value of the net assets is given, which is of the legal acquirer. It seems it could be a case of reverse acquisition. Subtle hint, but I think worth it. So it says the fair value of A's assets and liabilities are given and they're same as the carrying amount except the fair value of entities A, non-current assets, which is supposed to be 1500. The balance sheet immediately before the business combinations are given. So we are given, and in the balance sheet, it is very clearly indicative that this is a reverse acquisition because A is the legal acquirer, but he is supposed to be the accounting acquiree. And B is the legal subsidiary, but he is the accounting acquirer. So it is very clearly indicated that this is a reverse acquisition. But still, I am going to prove the point that it is a reverse acquisition because sometimes it may not be stated in the question. So I think we'll also do the calculations to identify that it is a case of reverse acquisition. Further, after the balance sheet, it says assume entities B earnings period ended. It says December X0 is 600 and the consolidated earnings is 800. That is in order to calculate the earning per share. And then it says assume that there is no change in the number of ordinary shares issued by B during the annual period ended December X0 and during the period 1st January X1 till the date of reverse acquisition. So it says assume that there is no change in the number of shares which are issued by B during the annual period ending December X0 and even during the period January till the date of reverse acquisition. Calculate the fair value of the consideration transferred, PC, measure the goodwill, and prepare a consolidated balance sheet on 30th September. Okay, so I think first of all, the focus in this particular question is to apply the 6 steps. Now you would say, sir, there were 7 steps, but in terms of reverse acquisition, we're going to apply 6 steps and we are going to make a consolidated balance sheet. Consolidated in the sense, he's asking me a consolidated balance sheet on 30th September. So I would say in case of reverse acquisition, we will not land up putting a journal entry, what we do in acquisition accounting. But the first 6 steps would remain absolutely similar, with of course some changes coming here and there, which we will see. So I think let's begin the journey. So first of all, I guess let's carry on the regular steps. I'm just going to keep the question in front of me. I hope you can also open the question. It's a study material question. So you can maybe also just keep the question. I will, of course, in between take you to the question as well. But I'm just keeping the question also in front of me. Okay, so first of all, I guess let's start with the step number 1. Just a second. Let me just open up the question also. Right. So I think let's begin with the inputs in terms of step number 1. So this is the answer to the question number 5. So I am first of all looking at the step number 1. So that is supposed to be the date of acquisition. I think that is very clearly visible. So you can see at the very start, it says 30th September X1. So date of acquisition is 30th September X1. Then we go on to the step number 2. And in terms of step number 2, we need to get the accounting acquirer. So the quick questions, what comes to the mind is that is there a new company created? Of course not. And is the consideration mainly in shares? Yes, it is only in shares. So therefore, we need to see the pre-business combination and the post-business combination percentages to identify is it a reverse acquisition or not. So let's see pre-business combination and let's see post-business combination and let's see the percentages as well. So in any case, entity A had 100% shares. The shareholders of A had 100% shares in the company pre-business combination. Now, what is the number of shares in the legal parent? I think if you look at the balance sheet of A, it has got 100 ordinary shares and A is issued a total of 150 ordinary shares to the shareholders of B. So let's see what is the percentage which is going to be post-business combination. So they've got 100 shares out of a total of 250 shares. So I think that works out at 40%. So which means in this particular case, we can clearly see that there is a dilution of control. Can I say earlier the shareholders of A had a 100% stake in the company and now they've got a 40% stake in the company. Not only the percentage went down, but the control is lost, which undoubtedly proves the point that this is a case of a reverse acquisition. So this would imply that this is undoubtedly a case of reverse acquisition. So as is already stated in the question, but still I wanted to prove this point, and therefore we can say the conclusion in this case is that as far as A is concerned, he is the accounting acquiree, though it is already stated in the question, clear and cut. And as far as B is concerned, he is supposed to be the accounting acquirer. There is another small little question which comes to my mind at this stage as we calculate the percentages. You know, considering that this is status is already given in the question that who is the accounting acquirer, do you need to conduct these calculations? I mean, just in case, what do you say? Are these calculations required? Or if it is already given that who is the accounting acquirer, I need not do these calculations. What's your take on that? Okay, I think I'll have to answer that question as well. I'll answer that question a little later. Let's, I think, proceed further. So now let's go on to the step number 3, and that is with reference to making the list of net assets. In the question, I am nowhere given a tax rate. So I think the concept of deferred tax implications in this 12 would not apply. But now we need to be careful that when you're making the list of net assets, we need to make the list of net assets of the accounting acquirer. Sorry, accounting acquiree. So which means in this particular case, when you're making the list of the accounting acquirer, we need to make the accounting acquiree, we need to make a list of the entity A. And I think I already said that earlier that, you know, when the question was telling you the fair value of the net assets of A, that was also indirectly a subtle hint that this is a reverse acquisition. So many inputs in the question. You know what? If you read the question initially, the exchange ratio seems to be too high. When you land up giving like 2.5 shares against 1 share, I think that high exchange ratio is quite indicative of reverse acquisition happening. The presence of the fair value of the net assets of A is an indication of, again, a reverse acquisition. And of course, it was already given that it is a reverse acquisition. Okay, so now let's look at the balance sheet of A. And I think except for the non-current assets, we are clearly given that everything is at the same book value. So let's begin with the net asset list. We have got the current assets. That is to the extent of 500. And the non-current assets is supposed to be 1500. So the current assets is 500. The non-current assets have got a fair value which is 1500. And I think that's it on the asset side. Then on the liability side, we've given the current liabilities, and that is 300. And we're also given the non-current liabilities, that is 400. That's all. There is no other liabilities or assets which are given. So no exceptions, no contingent liability, no indemnification, nothing in terms of exceptions. So this turns out to be, I guess, to the extent of 1300. So that is the net assets with us. So far so good. I think this is not at all technical indeed. So now I think comes the crucial game. Because I think reverse acquisition involves a very important calculation on the purchase consideration. That is the only tricky point. Other than that, I don't see that there is any challenge. So let's go on to the step number 4. So in terms of the step number 4, we need to calculate the purchase consideration. Now let's go on to the calculation of the PC. I asked you a question a little while back that, you know, we are calculating the pre and the post business combination percentages. And I said, do we need those percentages considering the status that it is a reverse acquisition is already given in the question? Well, the answer is a yes. Because if you want to calculate the purchase consideration, we do need that 40% percentage. Because when you calculate a purchase consideration, in case of reverse acquisition, you need to consider, though the consideration is paid by A, but you need to consider if it was paid by B, to maintain the same percentage. Because we've seen in terms of step number 2 that as far as entity A is concerned, he gets a 40% stake. And as far as company B is concerned, it gets a 60% stake. So we need to focus in terms of entity B. We need to focus in terms of entity B that if entity B would have paid a consideration in such a way that he wants to maintain that 60% stake, how many shares he would have issued. So in this particular case, we will calculate that if B wants to maintain, if B wants to maintain 60% stake post business combination, we want to calculate how many shares it would have issued. How many shares it would have issued. So that means we definitely need that 40% percentages calculated earlier in step number 2. So we need to now consider if B wants to maintain a 60% stake, how many shares it would have issued in this case. So let's consider if he would have issued, let's say, X number of shares. Now, entity B in the balance sheet of the company has got a total of 60 shares. And if he would have issued, let's say, X number of shares to the shareholders of X in such a way that he would have maintained a percentage to the extent of 60%, we now need to get the value of X. So we need to do the workings on the context that if shareholders of A are, let's say, given X number of shares by entity B, the total capital base of B would have been 60 plus X. So we want to calculate the X in such a way that B would have able to maintain that 60% stake in this case. I guess if we solve the value of X, it is 40, I think. Let me just still check this. I think yes, because 60 represents 60%. So it would be a total of 100 shares. So X becomes 40. So which means we've been able to calculate that if B would have wanted to maintain the same percentage of 60, he would have given 40 shares to the entity of A. So in a reverse acquisition, your purchase consideration is not what is issued by A. That is legal acquirer. But the purchase consideration is what would have been issued by the accounting acquirer. So in this particular case, the purchase consideration is B would have issued 40 shares in his company. And we need to multiply this with the fair value of the shares of company B. So B would have issued a 40 shares. And we've already seen at the beginning that the fair value of the shares of B is 40 rupees per share. So that works out at a purchase consideration. So I think if you go systematic, it's not very difficult indeed. The only focus point which you need to consider is that we don't need to consider what is issued by A. We need to consider what would have been issued by B in order to maintain the same percentage. I hope I am clear with the consideration, the PC calculation. Now, there is another input to be seen at this particular stage, and that is, there is another input which is given in the standard. And the standard says that if the consideration is only in equity shares, I'm not saying mainly, I'm saying only. So if the consideration is only in terms of equity shares, then in that particular case, to calculate the purchase consideration, we need to consider not what is given, but we need to consider the fair value of what is acquired. So we can consider that if the purchase consideration is only in equity shares, then only the provision which I am making a mention would apply. So you need to see that in this particular case, the purchase consideration is only in terms of equity shares. There is no other portion. There is no other component of any other form of payment. So we need to consider that not what B would have issued, but we can say if B would have issued what he would have got. Can I say if B would have issued these 40 shares, he would have got a control over the company's A share. So we need to consider the consideration, not the consideration paid, but we need to consider what is the fair value of what is received. What is the fair value of what is received, what is acquired? So B would have issued a total of 40 shares to the shareholders of A, and in return, he would have got the control over those 100 shares. So we can say that B would have got a control over 100 shares of A, and this is going to be multiplied with the fair value of A share. And we're also given very clearly the fair value, the market price of A share is 16. So the fair value of what is acquired turns out to be 1600. Now, what is interesting to watch in this particular case is the consideration computed is 1600. This is the fair value of what would have been given. And this is the fair value of what is acquired. And both are turning out to be 1600. So what do you think? Is this by chance that it is 1600, or do you think it is got to be? And this 1600, do you think is by chance the same, or do you think it is got to be? There's been a complete pin drop silence since morning when I started with reverse acquisition. Does this mean that I answer that question as well? Okay, so I think reverse acquisition seems to be quite technical indeed. So I think I'll have to answer that question as well. So this is, of course, got to be. And I will tell you why is this so, because I gave you the reasoning at the very start of the question as well. I said that the fair value of the share is 40 and the fair value of the other company is 16. And if you consider 40 divided by 16, it works out at 2.5, which is the exchange ratio. Since in this particular case, the exchange ratio is based on the market value of the shares, then I think in this particular case, this is 100% got to be. So when you calculate the consideration value, which is based on what is would have been issued vis-a-vis what is would have been acquired, it gets the same result. You know, I am interested in doing a little complicated chart as well at this stage. I don't know whether I should do that or not. So what do you say? Shall I? Because this is the calculation of the PC, but I'm just thinking that what are the different permutation combinations which could arise?
Yes,
Shall
sir.
we do the honors?
Yes,
While
yes,
we
sir.
get answers.
Yes, sir.
Great. So I think let me do one thing. I'm just coming out of this question for a little while, and I just want to test the conceptual clarity so that we all get very clear on the agenda. Because when I'm looking at the concept of a purchase consideration, my mind always tells me that broadly, you can say there are going to be basically, you can say four types of PC calculations. If the consideration is only in shares, so what I am doing at this particular case is the calculation of the PC. So I would look at the calculation of the purchase consideration, number, not reverse acquisition. Accounting. And the second is if it is a case of. So I'm looking at two permutation combinations, PC when it is acquisition accounting and PC when it is reverse acquisition. And within each one of them, I am looking at two permutations and combinations within each of these blocks. So I'm looking at the first one, that the purchase consideration is it's not only in equity shares. It's not only in equity shares, or the second is the PC is only in equity shares. So I think that would be interesting to watch the concepts. Here also we can say that the purchase consideration is not only, it is not only in equity shares. So the consideration is not only in equity shares, and the other one is that the purchase consideration is only in equity shares. It is only in terms of equity shares. Time now to put some questions to you. I hope you got the permutation combinations clear. Because today only we decided that if a purchase consideration is only in equity shares, you need to consider what is acquired and not what is issued. Otherwise, we always consider the fair value of what is issued. So let's begin the journey. Consider the facts of this particular case as a base and tell me if it is not a reverse acquisition, that means I'm considering A is supposed to be the accounting acquirer. We are considering that A is supposed to be the accounting acquirer. So would you like to tell me the purchase consideration in the first case? It's not a reverse acquisition and the consideration is not only in equity share. So would you like to tell me how many shares would you consider for the PC? Give me the PC. This should come from your side. Otherwise, the entire exercise of making this chart goes down. So what do you think would be the purchase consideration? It is not a reverse acquisition. How do you generally calculate a PC?
Shares issued to the acquiring and
Yes, so
fair
great. But can you tell me in terms of number, these many shares into this fair value? So can you give me the numbers?
100.
So A issued a total of 100 shares to the shareholders of B or 150?
150.
It's
150.
150. We need to consider the shares issued by A to B. That is shareholders of B. That is 150 shares. So can I say we'll take 150 shares issued by A to B? And what is the fair value of the shares?
16.
That's right. The fair value of the shares of company A, entity A is 16. So you
16.
get the purchase consideration. 150 into 16, that's 2400. Great. So this is the normal case. This is the normal case where we are saying, let me consider the fair value of what is issued. A actually issued 150 shares to the shareholders of B into the fair value of the shares of A. Let's now go the reverse way. It's not a reverse acquisition, but we are considering that the PC is only in equity share. Now tell me, by issuing 150 shares to the shareholders of B, what does A get? What does A get? He gets a control over how many shares? Just watch this carefully, analyze this. A issued 150 shares to the shareholders of B. In return, what is he getting? He's getting a control over what?
Number of B shares. That is.
That's right, absolutely. So can I say 60 shares of B into the fair value of B? That works out at 2400. I hope I'm clear on the first block. This is the two kinds of PC because we need to understand one thing, whether it is acquisition accounting or it is a reverse acquisition. One way is to see what did you issue. That is a normal way of calculating. But if the consideration is only in shares, the other way is to see not what you issued, but what do you get in return of issue. So when A gave 150 shares to the shareholders of B, he gets a control over company B. He gets a control over the 60 shares of B into the fair value of B. Now let's come back on the reverse acquisition, which you've already done. Can I say in this case, what we are saying that B is the accounting acquirer. In this particular case, we are saying B is supposed to be acquirer in this case. So let's consider if the consideration is not in shares. Now, this is what we've already done in the previous step. So I think you should be able to help me very easily on this. So tell me, if B is the accounting acquirer, which means a reverse acquisition, tell me the purchase consideration.
40 into 40. It is.
Right. What B would have issued to the shareholders of A into the fair value of B, that comes to 1600. This is based on what would have been issued. And now tell me, if it is a reverse acquisition and the consideration is only in equity shares, then what does B get? By issuing 40 shares to the shareholders of A, what is B going to get in return? By issuing 40 shares to the shareholders of A, what
100
is B
shares.
going to get return? Yes.
100 shares control it is going to get.
So he gets the control of the 100 shares of A, that's right. And the fair value of shares of A is 16. So
16.
that also
16.
works out at 1600. Now you can see all the permutation combinations very clear on this. Just to, I think, put it on a very safe side, I'm just going to put some wordings to this. In the first case, we can say this is the shares. Can I say which is actually issued? Undoubtedly, yes. Can I say in this particular case, can I say this is the shares which would have been issued? Which would have been issued? So you can see the contrast. That in acquisition accounting, you are considering what is actually issued. And in terms of reverse acquisition, you're considering which would have been issued. And then when the consideration is only in shares, so we are saying, looking at what is acquired. What is acquired, that by issuing these 150 shares, what do you get? You get a control over the 60 shares. And here also we are looking at what is acquired. Here also we're looking at the fair value of what is acquired. Had you issued 40 shares, you would have got a control over the 100 shares of company A, and that is the consideration. I hope, friends, this particular chart gives you a clarity of the purchase consideration, because in the previous one, in the PC calculation, I showed you two workings of the purchase considerations, and both the workings are shown very clearly in the study material. Because they very clearly made a mention that the consideration is paid only in equity share. So what is more reliable in nature? And you need to tell the examiner that what is more reliable in terms of calculation is not the fair value of what is issued, but the fair value of what is acquired. Right? I hope I am fundamentally clear on the agenda. Okay, your silence seems to be a deemed acceptance, though I think I'm getting the feeling since morning as we started reverse acquisition, it's getting dangerous. Is my feeling correct? So we're doing quick revisions on that. Okay, so this is step number we have done is 4. Now let's go to the step number 5. So let's go to the step number 5 now in this particular case. So in terms of step 5, we need NCI, but in this particular case, there is no NCI because all the shares of the company is been acquired. So no NCI. And then we come to the step number 6. No step 7, we directly make a consolidated balance sheet in this case. So let's go to the step number 6. And which is the calculation of the goodwill or the bargain purchase gain, which is going to be done absolutely in a normal manner. So let's see the purchase consideration. I think it is 1600, and to which we add the NCI, which is 0. So this total works out at 1600. And we compare this with the net assets, which is already calculated in step 3. What was the
1300. 1300.
1300? So we
1300.
get a goodwill to the extent of 300. So that's a simple mathematical calculations indeed. So I think the only focus, which I believe is the technical area in terms of reverse acquisition, is the calculation of the purchase consideration. Other than that, I don't see there is much challenge. Now with this, we go on to the step number 7. Now there are some crucial points which we need to consider when you are preparing a consolidated balance sheet in this case. Since the accounting acquirer is A, you need to consider the fair value of the accounting acquiree. So in the balance sheet, you're going to pick up the fair value of A and not B. And there will be some considerations to be seen when you are going to consider the share capital in the consolidated balance sheet. The legal requirement to make the consolidated balance sheet lies upon the entity A because he is the legal acquirer. But the balance sheet is going to be presented in such a way as if B is supposed to be the acquirer. So let's begin with the balance sheet. So let's consider the asset side. So first of all, on the asset side of the balance sheet, I am given, I guess, current and non-current, though I think we should write it in the reverse order. So non-current assets and the current assets. So in terms of the non-current assets, we will consider A at a fair value. And we will consider B, of course, at the balance sheet value, that is 3,000. So the focus point is that we need to consider A's value at fair value. B is going to be taken at a book value itself. So that works out at 4,500. And I guess least we forget, we can also take the goodwill as well. So goodwill is to the extent of 300. And then we consider the current assets. Rest, I think book values, fair values are common. So that is 500 and 700. So that, and I think that's it on the asset side of the balance sheet. So this takes care of the asset side. I think that is 6,000. Then we move on to the liabilities side of the balance sheet. So let's consider equity and liabilities. So first of all, on the equity section, we need to consider the equity share capital. So you tell me what would be the equity share capital which is going to be taken in the balance sheet. What's your inputs on that? Are we going to consider the share capital of the entity A or
A.
I think we have to consider the equity share capital of B and the
That's
PC
right.
received.
Absolutely, because since B is being considered as an accounting acquirer, so in this particular case, we will consider the share capital. B is got a share capital of 600 and the purchase consideration is 1,600. So we take the share capital of B plus the purchase consideration, that works out at 2,200.
But the number of shares, I think we
But
have
when
to
it comes
consider
to,
only 250, right, sir?
that's right, absolutely. So when it comes to the number of shares, we're going to consider this from the point of view of the legal acquirer, that A in the balance sheet has got 100 shares and actually 150 shares have been issued. So we are going to consider 100 plus 150, 250 shares. So this is another focus point which we need to keep in mind, that when you consider the number, the focus is the legal acquirer. And when you consider the value, the focus is the accounting acquirer. Other than this, we are given the retained earnings, that is supposed to be 1,400 for company B. So that's the section. Then on the liabilities, we are given the non-current liabilities as well as the current liabilities. So non-current liabilities are to the extent of 400 plus 1,100. That works out at 1,500 is the non-current liability. And the current liability is 300 plus 600, and that is to the extent of 900. And this should, I think, hopefully close the balance sheet.
1,000. It is tallying 6,000.
Yes, it is tallied. The balance sheet is 6,000. So my balance sheet is done. So that is reverse acquisition, which is based on is not created. There could be a possibility of a reverse acquisition. Right, friends? I hope I'm clear with the dots.
What will we write in the heading, sir?
On the top of the balance sheet,
Yes.
you mean to say?
A only.
We'll put on consolidated balance sheet as on whatever date it is. That's it. So it is, of course, where you can say legal acquirer A, but just put consolidated balance sheet as on 30th September X1. That's it.
Legal acquirer, we will write.
Yes, because technically this balance sheet is being presented, though we don't need this much. I'll zoom the upper part later for the question when we do. I hope we can manage with this. Right, I guess we can see not much information. So we're given AX and BX. I'm given AX and BX amalgamated from 1st January X2 and a new company ABX is created. So can I say if the purchase consideration is going to be in terms of shares, can I undoubtedly say it is a reverse acquisition? A new company is created and the consideration is in shares, can we undoubtedly say that it would be a reverse acquisition? Nobody vouched me on that. Undoubtedly, yes. Because in this particular case, if you're considering that this is a case of a new company, undoubtedly reverse acquisition. Why am I getting a feeling since morning that everybody is finds reverse acquisition too technical? My feeling is getting more stronger as I'm proceeding with the questions of reverse acquisition.
No, no, sir. No, no, sir.
Okay, because I'm getting
We
very
are comfortable. We are comfortable. Only thing is nobody is replying. That is, maybe they are having some doubts.
Okay, maybe I take that way. Okay, so let's take it further. So I am further given in the notes to accounts the breakup in terms of other equity. So this is nothing but the bifurcation of the other equity given in the notes. And then it says ABX issued a requisite number of shares to discharge the claims of the equity shareholders of the transferor company. Also, new debentures were issued in exchange of the old series of both the company. You're required to prepare a note showing the purchase consideration and the discharge thereof and the draft the balance sheet of ABX, assuming the companies are under common control. I think this is yet to be covered, so not concentrating on point A. Then he says, assuming that BX is a larger entity and their management will take the control. It says BX is the larger company and the management will take the control of ABX. Does this indicate that BX is the accounting acquirer? Absolutely, yes. Can I say in this particular case, BX is the larger entity, so he is undoubtedly becomes the accounting acquirer. And since the consideration is given only in terms of number of shares, as I said earlier, that if it is a case of a new company created with a consideration in terms of shares, undoubtedly it is a reverse acquisition. So in this case, we are already given the status that BX is the larger entity, but in any case, we'll still do the calculations to identify that it is a reverse acquisition. Because as I said earlier, you definitely need the inputs in terms of step number 2. Because in any case, that percentage is required to calculate the purchase consideration. And then the fair value of the net assets of both the companies, AX as well as BX, is given. So tell me, whose fair value would be required, AX or BX? In order to make the consolidated balance sheet, you would
X,
need the fair values of AX or BX.
X.
That's right, because BX is supposed to be the accounting acquirer, so AX becomes the accounting acquiree, so we need the fair values of AX. Okay, so I think let's proceed with the inputs on this. So let me just delete this. So this is question number 9. So let's solve the question number 9. 6 steps with this. So question number 9. So let's go with the 6 steps to begin with. Step number 1, we are looking at the date of acquisition. So let's see what is the date of acquisition in this particular case, very clearly given. The company is amalgamated on January X2. So we can say on 1st January X2, that is date of acquisition. Then we go on to the step number 2, and this is getting the accounting acquirer, though already stated in the question. But we still need to do the workings in order to get the percentages. So even if the examiner very clearly tells you that it is a reverse acquisition, but you still need those percentages because purchase consideration would require that. Now, let's, I think, go with the inputs. So can I say there is a company AX and there is a company BX? Now the question is, I need to first of all consider that how many shares are given. The question is very clearly said in the additional information, ABX will issue a requisite number of shares to discharge the claims of the company. So the question now arises, we need to calculate what is the requisite number of shares to be given. How would I calculate that? Because I'm not given the status of how many shares does ABX issue to AX or to BX. So help me, how would I do that calculations? Please share your
6
inputs
lakhs.
on that.
6 lakhs and 7 lakhs.
How
Number
do
of
you get the
shares.
6 lakh and 7 lakhs?
6 lakhs is AX Limited's number of shares, and 7 lakhs are the number of shares for BX Limited.
Okay, so you mean to say that you're just going to give them the shares which is appearing in the balance sheet directly? That's it?
No, we have to consider the fair value of the business.
Yeah, so that's what my question is. How would you calculate the number of shares to be given to them?
The total
Fair value of B
the
multiplied by
business
number
divided
of
by the
shares.
total fair value. Fair value of the business
Okay,
divided
that's
by
right.
the total business.
Okay, so first we need to consider that AX and BX is going to be given money based on the fair valuation which is given in the question. That's right. So let's, I think, first of all, consider what is the fair value of the business. So if I consider the fair value of the business, AX fair value is given in the question to the extent of, I think, 11,000. And BX has got a fair value 14,000. Now, when ABX will issue shares to them, since it's a new company, they will issue shares at a par value, and considering the par value is 10, so can you see we can divide this by the par value?
Yes.
So the number of shares to be given to AX as well as BX turns out to be 1100 as well as 1400. So this is the number of shares to be issued. This is the number of shares to be issued by ABX. So this is the number of shares to be issued by ABX to the shareholders of AX as well as BX. In totality, the company ABX will issue a total of 2,500 shares. I think now we can identify that out of these 2,500 shares, what is the percentage AX gets and what is the percentage BX gets, which will decide who is getting a control over ABX. So let's calculate the percentage. 1100 divided by 2,500. So let's see the percentages. AX and BX is getting the company. AX is getting 1100 shares out of 2,500 shares in ABX.
44%.
And this comes to how much?
44.
44.
44.
Yeah, 44 and
So
56.
AX gets a 44% stake. So automatically BX gets a 56% stake in the company. So as was very clearly given in the question that BX is a larger entity and is in control of ABX. But in any case, we proved the calculations. And as I said, we should do these calculations because I need that 56%. So in this particular case, 56% gives him control. So we can say he becomes the accounting acquirer. So company BX becomes the accounting acquirer. So that takes care of my step number 2. Now we need to go to the step number 3. Here again, no tax rate is given. So there is no application of Ind AS 12. We just need to get the list of the net assets considering the fair value of entity AX, which is the accounting acquirer. So let's go to the list of net assets. Maybe we can do it on the next page. So let's go to the step number 3. So let's get the list of net assets of the accounting acquiree. So we need the net assets of the accounting acquiree, which in this case is the company AX. So remember, whenever your focus is there on the reverse acquisition, you need to consider the list of net assets of the accounting acquiree. So we're given a couple of fair values of AX for PPE and inventory. So let's go in the order of the balance sheet. So PPE is to the extent of 9,500. That is the fair value. Next item in the balance sheet is supposed to be investments. That is 1050.
Not investment, sir. Inventory. Inventory is 135,
No, I'm
1300.
going with the order of the items in the balance sheet actually.
Okay, okay.
So I'm just going with the same order. So 1050. And the next I am given is the inventory. That is 1300. So inventory is 1300.
Trade
And
receivable is
rest all is at the book value. So next is trade receivable.
1800.
That's right.
Cash and
And
cash
the next
equivalent
is Cash and cash equivalents, that is
450.
450. I guess we can take the sum total of the assets, then reduce the liabilities.
We have borrowings and trade payables.
Yes, this is 14,100. And on the liabilities, we are given the borrowings 12% debenture, that's 3,000. And the other liability which is given is the current liability, that's right, trades payable 1,000. I think that's it. Nothing further is given in the additional information. No contingent liability, no exceptions. So I guess that comes to 10,100, I guess.
Yes, sir.
Wonderful. So that's also not a big deal. Getting the list of the net assets is pretty simple and straight indeed. Now comes the calculation of the purchase consideration. So in this particular case, this is reverse acquisition. So please help me. How would I calculate my purchase consideration? Step number 4. So please give your inputs on the calculation of the purchase consideration.
So he has given debentures as well as issues. So at consider
Debentures would not be
12%
part of the
debentures.
purchase consideration.
14,000 is coming to be the purchase consideration for 56%.
No,
by
but
BX.
what is the purchase consideration? That is list of net assets. That 14,100 was the list of assets.
Not 14,100, sir. 14,000.
What is 14,000?
Sir, it's the fair value of the business, so we'll consider it as PC.
Okay. That itself is the purchase consideration. What about the calculation of number of shares, etc., etc.? Oh my God.
number of shares are 550 into 20. That is one part of purchase consideration.
Okay, I think let me show the workings. You're not even using that 56 percentage. Where does that 56% go? Because we've just seen in the calculation of PC, in order to maintain the percentage, how many shares BX would have issued to AX? What about all those calculations?
That is coming to 550. That's what I was mentioning.
Okay. So let me, I think, show the detailed workings on this case. Let's, I think, work the calculation of the purchase consideration. Okay. So your answer is correct, but let's, I think, still get the details. So can I say, we know that the accounting acquirer in this case is company BX. So we need to identify how many shares. We need to identify how many shares BX would have issued. How many shares BX would have issued to maintain 56% stake, because BX is getting a total of 56% stake in the company, the combined entity. So we need to work it out that if BX wants a 56% stake. Now look at the share capital of BX in the balance sheet. How many shares does BX got? I think 700, I guess.
700. Yes.
That's right. So we can say BX has got 700 shares in the company. If he would have issued, let's say, X number of shares, then in this particular case, what would have been the percentage is 56%. So I now we solve the value of X and get the number of shares. That's 550, you said?
Yes, sir. That's what I said.
Okay, so that's 550. So X works out at 550 shares. Right, so my first calculation is done, that we have taken that 56% as a base, and with which we are trying to identify that if you want to maintain that 56% stake, how many shares would BX issue to the shareholders of AX to maintain the same percentage? So now let's calculate the purchase consideration. So can I say in this case, 550 shares would have been issued by BX, and we need to multiply this with the fair value of the share of BX, am I right? But I'm not given the fair value directly. I'm only given the fair value of the business, with which you need to translate that into the fair value per share. So let's do one thing. Let's make a small little calculations on the fair value. So can I say, let me calculate the fair value of both the companies AX and BX. So let's see what is the status of AX and BX. The fair value of the business is given to me. It's 11,000 and
14,000.
14,000. And let's divide this by the number of shares to get the fair value per share.
550 and 700.
So that's there in the balance sheet, 550 shares.
No, that's what we have arrived at just now.
No. I'm calculating the fair value of AX. So I'll take the number of shares on the balance sheet, 600 and 700.
600, I think. Yes, sir.
550 is the number of shares issued, which would have been issued with BX. That doesn't go in the calculation of fair value per share. So 11,000 by 600, that works out at 18.33. And this works out at 20. So now with this, we can calculate the purchase consideration as well. So in this case, we know the fair value of B share is 20. So 550 into 20, the fair value becomes 11,000. By the way, a small little question further in this particular case. This 11,000 and this 11,000 by chance the same or got to be? BX would have issued the shares to the shareholders of AX, and the fair valuation of the business and the purchase consideration computed, is this by chance or got to be?
Got to be.
Of course, 100% got to be. I'm just thinking at my level, though this is not really given the solution, but I have a little personal view on this. Isn't the consideration given only in the form of shares? Am I not now supposed to see that what is the fair value of what is acquired? What do you say? Because right now we have taken the fair value based on what is issued. But in this particular case also, I have a personal belief on this, that I think the same concept should apply, that if the consideration is only in shares, and which is the case in this case, shouldn't we also try to calculate the fair value of what is acquired? I think, let me make a check on that. So let's see, on an alternative, since we are giving only shares as a part of the consideration, tell me, by issuing the shares to the shareholders of AX, BX is going to get what in return? BX is going to get what in return? Can I say the
600
control
shares.
of 600 shares of AX? That's right. So can I say 600 shares of A into the fair value of
18.33.
out at 11,000? I'm just making a check because I think this becomes technically more reliable in nature. Just like the previous question, we said fair value of what is issued, but what is more reliable is the fair value of what is acquired. In this case also, this is the fair value of what is issued, and this is the fair value of what is acquired. The both are coming exactly same, and I think ideally they should always be the same as well. Okay. So I think that takes care of the step number 4. That is the purchase consideration. Now let's go to the step number 5.
In this question, I don't have the question. Were the debentures not given in the?
Debentures are given, but that's not a part of the purchase consideration.
Yes,
Debentures
yes,
is a
yes, sir.
replacement to the old
Correct,
debenture holder. That's
correct,
not
correct.
PC. That's not PC. Right. So now we go to the next agenda. That is step number 5. And there is no NCI again. So step number 5, there is no NCI. And then we go to the step number 6. As usual, calculate the status of goodwill in this particular case. So that would be PC plus NCI. So my purchase consideration was 11,000. And to this we add NCI, which is nil. So that works out at 11,000. And we compare this with the net assets. How much was the net assets in this case? 10,100, if I remember. Was it 10,100, I guess? That's right. So net assets is 10,100. So we get a goodwill to the extent of 900. Right, so that takes care of the step number 6. No journal entry. We're now going to make in step number 7 the consolidated balance sheet in this case. So my step number 7 would be making a consolidated balance sheet. So here again, as you make a consolidated balance sheet, your focus is that you're going to consider the fair values of AX, which is the accounting equity, and the book values of BX. So let's begin with the balance sheet. So first of all, on the balance sheet, non-current assets. So we have the property, plant, equipment. Let's take the fair value of AX. So PPE is appearing in the balance sheet for AX. The fair value is 9,500 and BX is 7,500. So that works out at 17,000. Next item in the balance sheet is, I think before that, let's take goodwill. So goodwill is computed at 900. Then there is investments in the balance sheet. We are not given any fair value. So investments is going to be 1050 and 550. So I think that works out at 1600, I guess. Then next we are given the inventory. As far as current assets are concerned, we've got inventory. We need to consider the fair value. So inventory for AX is 1300 and BX is 2750. So that's, I think, 4050, I guess. That's 4050. Next item is the trade receivable. So no fair values are given.
1800.
That's right, 1800 plus 4000.
5800.
1800.
Then cash and cash equivalents.
Cash and cash equivalents.
450 plus 400.
Okay, 450 plus 400, that's 850. That's it on the asset side of the balance sheet. Let's see the sum total of
total
the
is 30,000 through 200.
30,200. Great. So that's on the asset side. Now let's go on to the liability side of the balance sheet as well. So we've got equity and liability. So once we create a new company, then as far as the equity share capital is concerned, we need to be careful on this. So tell me, what will be the status of the equity share capital in the balance sheet of the company?
7,000 plus 5,500. That is 12,500.
That's absolutely correct. So we've got 7,000 shares of the company, that is BX, and we issued a total of 5,500 was the amount. 5,500 was the amount which we had taken. That was 550 shares of 10 each. So this is going to be 12,500. So this works out as the equity. Then there is other equity in the balance sheet. So other equity is going to be, I guess, 2,700.
Surplus securities premium 5,500.
Oh, yes, I missed that. Yes, you're right. Plus, we also need to consider the amount of security premium as well. So 2,700, and it was 550 shares. And what was the
8,200.
premium per share?
10 rupees.
That was 10 rupee.
Yes, yes.
Yes, so that works out at 8,200.
Yes, sir.
Okay, perfect. Then on the liabilities, we've got non-current liabilities, and they're issuing, I think, new 12% debenture. So this will be the same amount. That's 3,000, 4,000.
Yeah, 3 plus 4, 7,000.
3 plus 4, that makes it 7,000. And then we're given just the current liabilities, that is trade payable.
Yes, sir.
So that would also be added as it is. That is 1,000 and 1,500.
2,500.
That's 2,500. So hopefully this should close the balance sheet, tally the balance sheet as well.
Yes, sir. 30,000 through 200.
Okay, wonderful indeed. So that works out at 30,200 is the total of the balance sheet. Right, so that takes care of the case of reverse acquisition. We've done both the cases on reverse acquisition. One is a case where a new company is not created, and one is a case where the new company is created. So I think both the permutation combinations gets done. Okay, now I think let's go on to the next agenda. So I hope this is comfortable indeed. Now the third area, which is on the concept of a common control transaction, which is addressed by Appendix C. So let's take the journey now to the next area of discussion, and that is a case of common control transactions. So this is, I think, the easiest out of all the three accountings common control transactions are concerned, because in this particular case, the accounting is far very simple indeed. Now, let's, I think, first take a quick review in terms of the common control transactions accounting. Can I say number one, when you are considering a case of common control, just to remind ourselves, there has to be a case of a related party. So we need to first of all see that a common control transactions would happen when there is supposed to be a related party transaction. So we need to see that first of all, we need to see that the parties which were in control or joint control of the entities prior to the business combinations are also under the joint control after the business combination. So which means you need to prove that the party or the parties, you can say one or more entities, were in control or joint control of the entities before the business combinations. They are still under the joint control post business combinations as well. Now, when it comes to the common control transactions, we can put it like this. As far as the accounting is concerned, can I say we are going to record the net assets in this case? We're going to record the net assets in this case in the books of the acquirer. Is it going to be recorded at a book value or is it going to be recorded at a fair value? Since this is a case of a common control, we are allowed to follow the concept of what you call a pooling of interest method, which is similar to the concept of accounting standard 14, that is accounting for a merger. So in this particular case, the net assets are going to be captured at a book value and not at a fair value concept. So basically, you can say when it comes to acquisition accounting or reverse acquisition, the focus is on a fair value accounting. But when it comes to a common control, the focus is on the book value accounting. That's one focus. Another, will I be able to record any asset which is not in the balance sheet of the acquiree? If there is some asset which is not appearing in the balance sheet of the acquiree, can it find place in this entry? Yes or no?
No.
Absolutely correct. So if it is not in the balance sheet of the acquiree, it cannot find its place in the acquisition entry as well. So no new assets and liabilities can be captured. So you got to capture only those assets and liability which are in the balance sheet of the acquiree, and that's going to be captured at a book value. Next, the focus number two is when you consider in this particular case the purchase consideration. So in this particular case, the purchase consideration is going to be recorded at a face value. We are not going to capture any premium on the shares. So in terms of a common control, the equity share capital issued, if you're issuing shares as a part of the PC, we will capture only the face value of the shares and not the fair value. And of course, if you're giving some payment in cash, that of course will get captured. Whatever is paid as a part of PC will be captured. Now, the quick question which comes to the mind at this particular stage is the next. What do you do with the difference in this particular entry? If the debits are more than credits, then if the credit is more than debit, then. So your inputs on that, if there is a difference which arises on this entry, if the credit side is more than the debit side, can I take it as goodwill or is it going to be adjusted to other equity? I think I'll have to answer that as well. So this is going to be simply adjusted in terms of other equity. There is no concept of goodwill which arises in terms of common control transactions. If your debit side is more, you get a capital reserve part of other equity. And if the credit side is more, you get a loss and that is also going to be adjusted to the other equity itself. So the accounting is very simple and very straight indeed. Let's do a question on this particular area as well. So I have selected one question on the common control as well. Then there is another beautiful question which awaits you on acquisition accounting. Yes, I think now I can maybe shift this slightly to make it visibly more clear. Right, I hope you can see the question number 6. Right, so let's read the question number 6. This is on common control accounting. So we are given Maxi Mini is got two divisions, Maxi and Mini, and the information of assets and liabilities are given. So we're given the breakup of the assets and liabilities for both the divisions separately as well. And then it says it is decided to form a new company, Mini Limited, to take over the assets and liabilities of Mini division. Accordingly, Mini is incorporated to take over at balance sheet figures the assets and liabilities of that division. Mini is to allot 5 crore equity shares of 10 rupees in the company to the members of Maxi Mini. In full settlement of the consideration, the members of Maxi Mini therefore to become the members of Mini Limited as well without having to make any further investment. Okay, I think that's the entire inputs. And then I am given the requirements. So it says you are required to pass journal entries in relation to the above in the books of Maxi Mini, which is like, and in the books of Mini. And then it says also make the balance sheet of the two companies on the morning of 1st November X2. Now don't get sentimental on the fact that he's asking you to make a balance sheet on the morning, because I remember, this question originally belongs to the old course in CA final when this question came back in November 99. And at that stage, it was given in the question, same language, that you need to make a balance sheet on the morning of 1st November because the exam actually was on 1st November. So people got a little sentimental that what is a difference between, 31st October and the morning of 1st November? Technically, no difference in this case. So it says directors also ask you to find out the net asset value of the equity share pre and post demerger and comment on the impact of demerger on the shareholders' wealth. So there are a couple of focus points in this particular case. Number one, I am required to do the journal entries in the books of, you can say, the acquirer, which is Maxi Mini, and you can say the acquiree, which is supposed to be Mini. And then we're also required to calculate the intrinsic value. You can say you call it as a net asset value per share, or you call it as an intrinsic value, which is pre and post demerger. And we also need to explain the impact on the shareholders' wealth. So I think let's begin the journey. This is question number 6. So here the accounting is going to be pretty simple and straightforward. This is also a question in the study material itself. Let me just open the question also in front of me. Right, so I think let's first begin the inputs. Let's look at the entries in the books of Maxi Mini as well as Mini. So let me make 2 different columns to see the accounting entries in the books of Maxi Mini and Mini. So we'll first look at the accounting entries, which is required to be done in the books of Maximini as well as Mini. So we've got the book and the books of Mini. So let's, I think, first focus on the books of Maximini. So we're going to look at the balance sheet of Maxi Mini and look at the division, which is Mini. So let's first begin with the PPE. So we've got PPE. What is the book value of the PPE?
600.
That is not 600. We're looking at Mini division. So that's, I think, 200 book value. So the book value of Mini, we'll just look at the balance sheet of Mini in the question. I'll just quickly show you. So we are concentrating on the Mini division. So this is the entire assets liability in the Mini divisions column.
Okay.
So PPE gets recorded at a book value. Next item in the balance sheet is, I guess, current assets.
And this is
That
300.
is 300. Next, I think that's it on the asset side. The next item is the current liabilities. That is also 100. Then there is, I guess, loan, which is also on the liability side, which is also 100.
100.
And then we need to consider the purchase consideration. So tell me, what would be the purchase consideration? We're going to issue equity share. We're going to consider face value of the shares allotted. So what is the number of shares? It says Mini is going to allot 5 crore shares of 10 rupees. So the face value is 50 crores, 5 crore shares of 10 each. And I think that's it. So any balancing figure is going to be taken as other equity. If the debit is more, let's take it as a capital reserve, which again is a part of other equity. So I think we're getting a balancing figure of 250. So there is a balancing figure 250, which is capital reserve, which is going to be taken as a part of other equity in this case. Correct. Can I say, as far as Mini is concerned, the objective is to close all those assets and liabilities which are taken over in this particular case. So, okay, I think I've written it the other way around. This is the books of Mini, right? Oh, I've written it the other way around. This is the books of Mini, and
That's
we'll do the
okay.
books of Maximini. So this is the books of Mini, and this is now the books of Maximini. That is the old company. This is the old and this is the new company. Okay, now coming back to the inputs in terms of Maximini, can I say the objective is to close all those assets and liabilities which have been transferred to Mini? So can I say we'll just close those assets and liability, debit the liabilities, credit the assets? Is my thought correct?
Correct.
So let's, I think, first of all, debit the liabilities. So we've got current liabilities gets a debit. That is 100. Loan gets a debit, which is again 100. As far as PPE is concerned, you can close the accumulated depreciation separately by giving it a debit, and the PPE can be closed separately by giving it a credit. So PPE, the accumulated depreciation is 100, and the gross block of the cost is 300. And then we're also in the current assets. Yes,
300.
that's 300. I think that's it. Nothing else is given in the balance sheet of, I think, Maximini. So what do we do now with this difference? Where am I going to transfer the difference in this entry? Debits, credit difference. We are getting a difference on the debit side.
Loss and
That's
reconciliation.
right. So adjusted against in terms of other equity. So let's see the balancing figure. This is a loss which can be adjusted against the other equity. So I think this is 300.
Yes.
Right. So I think this takes care of the accounting entries in the books of both the companies, the old as well as the new company. So we can say this is like the new company and this is like the old company. So in the books of old company, the objective is to close the assets and liabilities which have been transferred. And of course, the books of the new company, it's like an acquisition entry, but of course, all at a book value. Right, so I think my first focus point is done. The requirement number one is partly got answered. Journal entry in the books of Maximini as well as many. Now we are required to make the balance sheet of the company, which I would also need for the purpose of calculating the intrinsic value. So let's make the balance sheets of the company now. So we can take the structure from the question itself and let's organize the balance sheet of Maximini pre and post demerger. So we'll look at the balance sheet of Maximini, that is pre and post demerger. And as far as Mini is concerned, of course, it is post demerger. There is no pre-demerger balance sheet in this case. So this is post demerger only. So let's first copy the balance sheet from the question and then we just do the plus minus. So I'm just going to pick up the information from the balance sheet. So let's take the non-current assets. So this is appearing at net 300. I'm taking the book value itself. This is 300 PPE. Then there is a current assets, which is 700. And I guess that's it on the asset side, I think. So that's all on the asset side of the balance sheet. 1,000. Then on the liabilities, we've got equity. So in terms of equity, we are given the equity share capital. I guess the equity share capital is 50 and the other equity is 650. I'm just copying the figures from the balance sheet as it is. Next, I guess we are given in the non-current liabilities, there is loan to the extent of 100. And then there is a current liability as well. The current liability is, I guess, 200. So let's see, is the balance sheet agreed? So I think this is 700 and that becomes 1,000. So right. So this is the balance sheet of Maximini, which is pre-demerger, which is copied directly from the question itself. Okay, now moving further, now what do we need to do? Can I say the entry which you did in the books of Maximini incorporated in this balance sheet? You get the balance sheet post-demerger. So tell me what will be the PPE? How much did I credit the PPE? I think it was 200. Was given a credit to the extent of 200. So this is the elimination of the PPE. So can I say the leftover is supposed to be 200 out here? So what about the current assets in the balance sheet? I guess current assets is 300 derecognized. So this is 400 and 300 gets out here. So this is total 500 and this is total 500 again. As far as equity share is concerned, it remains the same. And here the purchase consideration was 50 crores. So that becomes the new share capital of this company. Now let's look at the other equity. There is a loss to the extent of 300. So loss of 300 would mean minus 300, that makes it 350. And what was the capital reserve in this case? 250. So this works out at 250 other equity capital reserve. Then I think loans, I remember, is passed on out here. And what about the current liabilities as well? So current liabilities also is to the extent of 100. So current liability is 100 and this is 100. Let's see if the balance sheet is tallied on this. Pretty simple and pretty straight indeed. So this is, I think, 500. And this is also 500. So that answers the requirement number A. This is the balance sheet of the acquiree. Sorry, you can say the new and the resultant company. So this is the entries in the balance sheet done. Next focus point is getting the intrinsic values. pre and post demerger, and comparing shareholders' impact on the wealth. Okay, so let's, I think, come back on the agenda. So if I want to calculate the intrinsic value or the net asset value per share, can I take the sum total of the equity share capital plus other equity, or alternatively assets minus liability? So either I consider assets minus liability, or can I alternatively take the share capital plus other equity that becomes the net assets available to the equity shareholders?
Yes, sir. Because it is at book value, we can do that.
Absolutely correct. So we can take the sum total of this, that becomes the net assets. So I think I'll organize it separately. And the number of shares is, of course, 5 crores. So let's organize the data. So let's see the intrinsic value, or you can call it as the net asset value per share, or you can call it as the intrinsic value per share, one and the same thing. So we'll organize the values for pre-post demerger. So this is maxi mini, this is mini, this is post, and this is pre as well as post. So let's organize the net assets divided by number of shares. We get the intrinsic value per share, or the net asset value per share. So let's pick the data back again. So this is 700, 400, and 300. 700, 400, and 300, and the number of shares is 5. So let's get the intrinsic values per share. So I think this is 140. This is, I guess, 80. And this is, I guess, 60. Right, so the second requirement of the question also gets answered. We get the intrinsic value of the shares as directed in part B. Now we need to explain the impact on the shareholders' wealth. So, quick question to you, friends. Can I say what is the exchange ratio? Can I say the shareholders of Maxi Mini got exactly the same number of shares in Mini? The share capital of Maxi Mini was 5 crore shares, and they got exactly 5 crore shares. So can I say they've got 1 share for every 1 share in the new company? So can I make a statement that earlier the shareholders have got only 1 share in Maxi Mini? Now with this particular restructuring, can I say they've got 1 share in Maxi Mini and they've got 1 share in Mini? So they've got 1 share in both the companies each. Is the thoughts correct?
Correct.
Absolutely. So I think let's calculate the
Can you
impact.
repeat this, sir? Can you repeat this one
Yes, I'll just
lastly?
repeat that as well. You see, what I'm looking at is, if you look at the share capital of these companies, we can say this was 5 crore shares of 10 each, and even shares of 10 each. So every shareholder gets 1 share in Mini. It's 1:1. The share capital of Maxi Mini was 5 crores, and the shares of Mini is also 5 crores. So every shareholder of Maxi Mini became a shareholder of Mini, 1:1 exchange ratio. So what was the position pre the demerger? That every shareholder had 1 share in Maxi Mini. Now he's got 1 share in Maxi Mini and he's got 1 share in Mini. So can I say we need to compare the wealth, 1 share of Maxi Mini pre demerger vis 1 share in Maxi Mini plus 1 share in Mini. Got my point, I guess?
Yes, sir.
Great. So let's see the impact on shareholders' wealth. So let's see what is the impact on the shareholders' wealth in this case, comparing the position pre as well as post demerger in this case. So we can say earlier one shareholder had 140 in Maxi Mini. So his wealth was 140 per share. Now he's got 1 share in Maxi Mini, which is worth 80, and he's also got 1 share in Mini, which is worth 60. So the wealth still remains intact at 140. My question now, If the exchange ratio was not 1 is to 1, or let's say it was other than 1 is to 1, do you think still the shareholders' impact would have been same, or do you think it would have undergone a change? If the exchange ratio was not 1 is to 1, do you think the shareholders' wealth impact would still remain the same or will undergo a change?
Should undergo a change.
I'm afraid no. It will not undergo a change. You want me to prove that point to you? I can.
Yes, sir.
Okay, let me prove this to you. Let's consider if the exchange ratio, was 1 for every 2. If it was 1 for every 2, let me just go back and prove the inputs. Can I say if it was 1 for every 2 shares, then in this particular case, can I say this would have been 25? Am I right?
Yes.
Because if you would have issued 1 share for every 2 shares, you would have issued 2.5 crore shares. So your consideration would have been 25 crores. So can I say accordingly, this would have changed to 275? Am I right? Because this would have become 2.5 crore shares of 10 each. Then accordingly, the amount of the other equity in the balance sheet changes to 275. So the net asset still remains the same. Now let's go further. So can I say in this particular case, instead of dividing this by 5, I would have divided this by 2.5. If I would have divided this by 2.5, so what would have been the value per share
120.
in this space?
120.
That would have become 120 in this particular case. So I guess now if you look at the calculations, I guess earlier the wealth was 140, now it's going to be 1 share 80, and he is getting what? Can I say this calculations will change? Can I say this will become 0.5 shares at the rate of 120? Because he's getting 1 share for every 2, so he's getting half a share for every 2, correct? So that
Yes.
means this will become 0.5 shares at the rate of 120, still because it's 60. So the ratio of exchange would actually not make a change. The basic essence in this case is, since everything is occurring at a fair value, at a book value. So in this particular case, since everything happens at a book value, this demerger is not going to result impact on the shareholders' wealth. Right. I hope I made my point on that. So all the 3 requirements done, the journal entries, the balance sheets, the intrinsic value, and the shareholders impact done. That was common control transactions accounting. Okay, so we are done with the 3 accountings: acquisition accounting, reverse acquisition, common control. But there was one particular question which is there in the study mat, which I said is a pretty long question indeed. And it might be difficult to solve the entire question. So what I am planning is to actually, discuss that question with you. It's a question in the study material which involves a lot of inputs given indeed. So I think I want to make a discussion on that particular question. So you've got a choice. You want me to discuss that question? Because I think doing that question is going to take a lot of time indeed. But I think through our discussions, we can at least get a hold of what is to be done under each step. Or you want me to do some other questions practice? Your choice.
No, we will discuss and we will not solve, sir, so that we
Okay,
can
so I
understand the
think that's
concept.
great. I think you know which question I'm referring to. It's a question in the study material. Wonderful question indeed. It's contained plethora of things. I have saved that on my board already. But I think before that, I think, give you a break. So I think, relax the minds before we look at that beautiful question indeed. So enjoy a break, friends. 10, 12 minutes. I join you back after the break. You had a relaxation of mind. So now comes a very interesting question. I love that question. I hope you also love that question indeed. It's one of the questions which came in the RTPs as in there in the study material as well. I think we want to get fundamentally very clear. I think this is a must do question indeed because it got a lot of concepts which are there in this question. So let's, I think, start reading that question with you. I think the question itself is pretty long, and I think it's covering around almost 2.5 pages. I'll just probably adjust this. So let's keep it larger so you can watch it carefully. I think this should be visible. It's November 2019 RTP question. I hope that works well. So question number 8, I think let's start reading this particular question. We'll keep analyzing the inputs with reference to the steps. So I think the main issue is that as we read the question, you should be able to connect that in which particular step, what are you going to do? That's the main idea. Let's begin. It says H acquired equity shares of S, a listed company, and this is in 2 tranches in the below table. Is there anything which is coming to your mind as you see that 15% equity stake was acquired and then another 45% stake is acquired? So is there anything which is coming to your mind at this stage?
Step acquisition.
Wonderful indeed. So can I say if it is a step acquisition, my mind should immediately start telling me that this is a case of conversion to a passive investment into a control. This means that before the acquisition accounting, there is a need to go for a fair value upliftment. Now, my question is that once you're going to compare the book value and the fair value of this investment on the acquisition date, where are you going to put the gain or loss arising on the fair value? I'm going to ask a lot of questions on this particular question now. So when you're going to consider the fair value upliftment or downwards, whatever, so where are you going to capture the difference between the fair value and the book value of this existing relationship?
PNL.
Can I say depends? If you are accounting this investment as per 109 at FPTPL, then it goes in the PNL. And if it is accounted at FPT OCI, then it enters the other comprehensive income. I'm just going to make a point, a note at this stage. Whether this investment is accounted at FPTPL or not mentioned at this stage. Later it can be seen. So the basic thought which should immediately come to your mind is that as soon as you look at this information, what comes to the mind is it is a step acquisition. It is a case of a previously held investment. So your mind should immediately tell you the accounting treatment. And the accounting treatment in this particular case is that we need to consider that it is a conversion from a passive investor to a situation of control. And if it is a situation of conversion to a passive investor to control, we need to consider the comparison of fair value versus the book value, and this difference depending upon Index 109, whether it is accounted at FPTPL or it is accounted at FPT OCI, of course, NR. Accordingly, we will take the difference in the PNL or the OCI. So if it is measured at FPTPL, you're going to put it in the PNL. And if it is measured at OCI, it enters the OCI. Here we're just learning the art of reading, analyzing the question for the solution. And this in the entry before, this will be taken in the entry before acquisition accounting. It's a pre-acquisition which will get impacted. Okay, then I think let's read further. So it says in the remarks that the shares were purchased on the quoted price on the stock exchange on the relevant dates. So I think that doesn't concern me at this stage. Both the above mentioned companies have a functional currency as Indian rupee. Consequently, H acquired a control on 1st January 17. Naturally, the control came in on the second date of acquisition. And then I am given the balance sheet of S Limited, and we are giving the carrying value as well as the fair value in the books. Immediately, as you see this information, what goes at the back of your mind now? So you look at that, there is a carrying value and there is a fair value. So immediately what shoots your mind looking at the carrying value and the fair value differences? I'm waiting for answers on your side. I think it should immediately trigger that if a tax rate is given in the question, then that would lead to deferred tax implications. Step number 3A. I hope I'm making sense.
Yes.
Yes, so I think let me pinpoint this as well. As you read this along, what comes that this difference between the book value, which is not equal to fair value, is going to lead to deferred tax implications, provided the tax rate is given in the question. So this will lead to deferred tax implications, and that would be the impact in terms of step number 3A, if the tax rate is given. Okay, so I think that's it on the balance sheet aspect. Let's move ahead and let's read further. Now, after the balance sheet, there is a lot of additional information which is given in the question. So let's have a read on the additional information. It says property, plant, equipment in the above balance sheet includes a leasehold motor vehicles having a carrying value of 1 crore and a fair value of 1.2 crores. It says the date of inception of the lease was 1st April 2010. On the inception of the lease, it says S had correctly classified the finance lease. However, if facts and circumstances on 1st April 17 are considered, classified as an operating lease. Can I say this input is not exactly valid, because now all the leases, unless they are supposed to be, you can say low valued assets or they are short term lease, are always considered as finance lease. So I think I am considering the point that this is undoubtedly considered to be a finance lease. So I'm ignoring the sentence that if at the inception it would have been taken, it would have been operating lease. So we are considering that this is not to be taken as operating, but let's continue to be a finance lease. Now it says following is the statement of contingent liability. As you see the concept of contingent liability, what comes in your mind?
Yeah, it is a off balance sheet item.
That's right, but what should be the implications?
Yeah, we need to record
So can I say in step number 3B,
at the fair value.
I'm going to consider the list of net asset. It becomes a case of exceptions where these liabilities will be captured at a fair value. Correct?
Yes, sir. We need to capture at fair value.
Yes. So we're going to consider the impact in terms of step number 3B. So we are going to consider the contingent liabilities as a part of the net assets. So when we're going to make the list of the net assets, we're going to consider these contingent liability, provided, of course, the fair value of these liabilities is clear-cut identified. So I am already giving liability. It says there is a lawsuit by a customer for a claim of 2 crores. The fair value is it is not probable that outflow of resources will be required. Any amount which would be paid in respect of lawsuit is tax deductible. Does this make a difference that the probability of outflow is not there? Will I still consider this as a part of my list of net assets, considering the probability of outflow is not probable?
Sir, even though the probable item is not probable, so when the fair value is determined, then we can consider this.
Absolutely correct. Because when you consider the contingent liabilities for the purpose of Ind AS 103, it overrides the provisions of IS 37. The acquiring company would have applied IS 37 to decide whether this contingent liability or is it a case of provision. But when it comes to Ind AS 103, the acquirer is required to only evaluate two parameters. One is that it is a present obligation, and the second is the fair value can be estimated. The probability of cash outflow is not a recognition criteria under 103. Great. Then he says the 7 crores raised by the tax authority, S challenged the demand in the court. It is again, it says not probable that outflow of resources will happen, but that's an irrelevant information. It doesn't make a difference to me. So this is, we can say, not a condition. It is not a condition as per Indes 103. This is only required as per Indes 37, not to be evaluated as per 103. Okay, let's go further. It says in relation to the above mentioned contingent liability, S is given an indemnification undertaking to H up to a maximum of 1 crore. So will this also result in, it says 1 crore represents the acquisition date fair value of the indemnification undertaking. So is this also going to be a part of my step number 3B? When you're going to consider the list of net assets, we said that there are certain exceptions. Is that indemnification asset also a part of the list of net assets?
Yes, sir, definitely. We need
Absolutely.
to, yeah, we need to record this only to the extent of the contingent liabilities already assessed. Say example,
Yes.
0.5 is there, uh,
And 2
only to
crores
that
minimum.
extent alone.
Absolutely. So we can say the indemnification asset cannot exceed the value of the contingent liability recorded in the books of accounts. But in this case, of course, it is less. That's absolutely correct. So the assets is also going to be a part of the net asset list. Okay, now let's, I think, see further what is given. Then he says any amount received in respect of the above undertaking shall not be taxable. So what would this lead to? When he says any amount received is not going to be taxable, what does this imply?
Sir, this will not form up the TTA or TTL.
Wonderful indeed. Because if it is not taxable in nature, this means that the impact implications of Indes 12 in this particular case is not going to result in any deferred tax implication. Then he says the tax base of the assets and liabilities of S is equal to the respective carrying values taken in the balance sheet. So the carrying amount is equal to the fair value. And as far as the tax base is concerned, that would be equal to the carrying value given itself. Then he says the carrying value of the non-current assets held for sale is 4 crore, which is fair value less the cost to sell in accordance with the relevant index, that is 105. So what is he trying to hint upon? NCA held for sale.
Sir, we have to consider the NCA always NCA a fair value less the cost to sell, not a fair value.
Wonderful. Absolutely. So that again becomes an exception to my step number 3B, where the NCA held for sale is captured at the book value, which in this case is the fair value less cost to sell. Brilliant indeed. So I think let's make a point on that as well. So this is also going to be a part of the step number 3B. And this will be taken at book value itself because this is an exception, NCA held for sale. Okay, so let's now go further and read inputs. Then he says, in consideration of the additional stake purchased by H on 1st January 17, it had issued to the selling shareholders of S 1 share for every 2 shares in S. So he says, in consideration of the additional stake purchase, he is now giving you the information on the purchase consideration. How did we pay for the additional stake acquired in the acquiring company? We issued 1 share for every 2 shares, and the fair value of the share is 10,000 rupees per share. So I think this is going to impact my purchase consideration, that we will consider the fair value of the shares issued. Then he says on 1st January 2017, H paid 50 crores in cash to the shareholders of S. Then he says additionally on 31st March 19, H will pay 30 crores to the selling shareholders of S if the return on equity for the year ended is more than 25% of the amount. What is this indicating? He's giving shares, he's giving cash, and he's saying, I'm going to pay some money after another 2 years, provided certain conditions are met.
Contingent consideration.
It is a contingent
Absolutely correct.
consideration.
And this is CCE or is it CCS?
CCE.
No, I think it's S because the service condition is not there. We're given that if return on equity is supposed to be more than 25%, so the condition is not on the service. So CCS, where we'll consider the fair value as a part of the PC. That is going to be step number 4.
Right, sir. It's not a employee. It's
Yes,
a shareholder
yes,
condition.
absolutely. So I think you can see as of now so many beautiful points in the question pertaining to the concept of step 3. This is only one good question which has got huge points relating to the step number 3. Okay, then I guess we can go further. So I am given that H is estimated the fair value of this obligation on 1st January 17 and 31st March 17 to be 22 crores and 23 crores. Why is he giving me the fair value on March 17?
Because we need to consider the previously held. There is some shares are we previously held. No, we need to identify it as a fair value for that.
No. This is not PHI. He's talking about the contingent consideration. He says that H estimated the fair value of this obligation is talking about the CCS on the date of acquisition and on the balance sheet date is given. He gives you the fair value of the contingent consideration on the acquisition date as well as on the balance sheet date. Why on the balance sheet date?
Yes,
Sir,
sir. We
on
need to consider. Yeah, we need to consider that fair value for
So
that
can I
contingent
say we need
liability.
to update the fair value through P&L? It's a financial liability which is going to be remeasured on the balance sheet date, updated at a fair value post business combination.
Yes, sir.
Absolutely. So I think we can make a mention out here in this particular case. We can say post business combination. The contingent consideration paid to the shareholders' capacity is supposed to be a financial liability which is measured at FPTPL. So this amount remeasurement gain or loss will enter the P&L. So you can see that he's given you inputs with regard to the entries prior to the acquisition date. PHI. He's also given you inputs which is with reference to post business combination, which is the CC remeasured. And then he adds on further inputs as well. It says the changes in the fair value of the obligation is attributable to the changes in facts and circumstances after the acquisition date. What does this mean? The changes in the fair value of the obligation is due to changes in facts and circumstances after the acquisition date.
Sir, if there is a change in facts and circumstances, then we will not consider the fair value, but we'll consider the value that was there on acquisition date. Sir,
No,
that
no,
is
no,
some
no, no. In any
kind of a
case, the fair
concept.
value changes is going to be captured. That is for sure. Whether it leads to the change in facts or circumstances, fair value changes will in any case be captured because this is a financial liability as per 109. Okay, let me, I think, pinpoint that. There is a concept which I did not revise with you, but it relates to the concept of a measurement period concept. Can I say if there is a condition which is present on the date of acquisition and there is something which happens later, so due to this, if there is any change in fair value, you will adjust it against the goodwill arising on a business combination. But if there is any kind of things which change post the acquisition date, but there was no condition on the acquisition date, then the fair value changes are taken in the profit and loss. Because any asset or liability which arises because of, let's say, on the date of acquisition, the facts and circumstances gave you a certain different fair value. Then post the acquisition date, which is 1 year from the date of acquisition, you see that there are changes in the facts and circumstances. Now, if there is a condition which relates on the date of acquisition, you need to consider that as a measurement period concept and the fair value changes of that asset liability adjusted against goodwill. But if it relates to not a condition on the acquisition date, then it is adjusted against P&L. So in this particular case, when it says that the fair value changes are due to changes in facts and circumstances after the acquisition date, which means there is no condition which is prevailing on the acquisition date. So all the fair value changes will get captured in the P&L. Had it related to the acquisition date, you would have changed the goodwill in this case. Right? So this input we can say is going to tell us that we need to capture the fair value changes in the profit and loss and not against goodwill. Wow. Let's go ahead. Then there is no information which is given out here. The quoted price of the shares is given. So we give the quoted price of equity shares on various dates is given. So I am given on November 16, January 17, and 31st March 17, which is the fair value of the equity shares of S. Then he says on 31st May 17. What was the date of acquisition? I guess January 17, I believe. My date of acquisition, I think, was January 17.
Yes, sir.
Correct. 1st January 17, when you got a control. Now he's talking about 31st May 17. It says H learned that certain customer relationship which were existing on 1st January 17, which met the recognition criteria of intangible assets on that date, were not considered during the accounting of business combination for the year ended March 17. The fair value of such customer relationships on 1st January 17 was 3.5 crores. Assume that there are no temporary differences associated with customer relationship. Consequently, there is no impact on the income taxes. What should I be doing with this? He did not record this customer relationships on the date of acquisition. And now it says on 31st May itself, H further learned due to additional customer relationship being developed during this period, January to 31st March, the fair value of relationship increased to 4 crores on 31st March. So what do you say? What is he hinting towards? That there was a customer relationship which was not captured on the date of acquisition as a part of the business combination accounting, and now he is realized on 31st May with some more facts and circumstances, more insights coming in. What is the hint?
So this will impact goodwill and we will recognize this as an asset because it is within the measurement window.
Wonderful indeed. That's right. Since it is within the measurement period concept, that's one. Within 12 months from the date of acquisition. Yes.
Sir, one more thing, that 3.5 crore is within that control date, so that the 3.5, that 4 crore has raised after that control is taken. So that 4 crore adjustment will not happen. We will not include the 4 crore. Instead, we can include only 3.5 crore alone in this.
Yes. So
because
that is
it happened. Yeah.
Correct. So you're right. So in any case, as far as the valuation is concerned, that will take in later. But one thing which can be pretty said is that this is definitely a measurement period concept, because it relates to the conditions which were present on the date of acquisition. So it relates to a measurement period, and therefore any impact of this. So we can say the impact of this is going to affect the goodwill in this particular case. So once you know that it is there on the acquisition date, so it's a condition on the acquisition date, you get new facts within 1 year from the date of acquisition. It's within a measurement period, and therefore the hit will be taken. Okay, let's, I think, go further. Then it adds on. On 31st December 17, H established that it has obtained all the information necessary for the accounting of the business combination, and more information is not obtainable. So should this be considered as the end of the measurement period date? Because the measurement period ends, you can say, at the earlier of the two. That is the date when all the information obtainable has been obtained, or 1 year from the date of acquisition. Can I say whichever is earlier? So should I consider this to be a cut-off date for the measurement period concept?
Yes, sir.
That's right.
Yes, sir.
Absolutely. So this can be taken as the end of the measurement period concept.
But measurement
taken,
can 1 year, more than 1 year.
Yes, it's supposed to be the end of the cutoff date. Then he says H and S are not related parties. If they're not related party, can I say common control accounting is definitely out of the picture? That's going to be either a case of reverse acquisition or acquisition accounting, and they follow Ind AS for financial reporting, and the income tax rate is given, which is indicating what? That we need to apply step number 3A, that is deferred tax implication. And we got a couple of fair value and a tax-based differences given. Now let's look at the requirement of the question. You can see that it's taken us almost like 25 minutes or so to just to read the question and analyze the question. Solving this question takes a plethora, but we'll do one thing. We'll, I think, maybe do just, the main crucial steps in this particular case. Okay, so then it says
Right,
you are
sir.
required, yes. So it says you are required to provide your detailed responses to the following with reasoning and computation notes as well. Wow, the requirement of the question is quite comprehensive. You need a detailed response along with the reasoning and the computation of notes as well. What should be the goodwill or the bargain purchase gain to be recognized by H in the financial statements for the year ended 31st March? And for this purpose, measure the NCI using PASNA, that is a proportionate share of the fair value of the net assets. Will the amount of NCI or the amount of goodwill or bargain purchase gain recognized in A above change subsequent to 31st March? What do you say, yes or no? Considering the facts of the case, do you think the goodwill or the NCI is going to undergo a change because of the measurement period concept?
Yes, sir.
Definitely yes. So can I say due to the measurement period concept? Due to the measurement period concept in this particular case, we can undoubtedly say that there is going to be a change in the NCI as well as the change in the goodwill. And then he says, if yes, naturally when the question says if yes, it is always a yes. Provide the relevant journal entries as well. And what should be the accounting treatment of the contingent consideration as on 31st March 17? Wow. That makes it a brilliant question indeed. I just love the intensity of the question, that the question is, testing you from all the ends. I think the main focus in this question is the step number 3AB as well as the step number 4, and of course the concept crucial in terms of measurement period concept. Let's, I think, begin the journey, friends, on this. We can do some crucial inputs in this particular question, I guess. So let me just open the question. You can also open the question in the study material. This question is already there in the study material as well. So maybe we can just focus on step number 3A and 3B to begin with, and maybe on the calculations of the purchase consideration. So we'll just do bits and pieces of this.
Yes, sir. I think only the SPP only is missing, share-based payment. Only adjustment is missing in this question.
You're right. Yeah, I think your mic was not working since morning. I think you're the only person who's active in terms of answering questions, I guess.
Sir, actually, I put it in other system now, using my mobile phone instead of laptop.
Oh. So that's, I think, quite encouraging to see the dedication with which you have entered. Wonderful indeed. Super.
Yes, sir.
Okay. So let's come to the question number 8 and let's begin the input. So you can please keep the question in front of you. It is in the study material. So I'm just going to start the inputs in this particular case. So I think let's first quickly get the step number 1 and 2, which is not a big deal. So can I say in terms of the step number 1, I am looking at the date of acquisition, which is clearly given. Can I say the second date? Because we acquired the shares in 2 tranches. So one was on November 16, but that time we did not get a control. Can I say January 17? That is the date of acquisition. It is the second date on which we achieved a control that becomes the date of acquisition. Then let's go on to the step number 2, which is on getting the accounting acquirer. So in this particular case, is a new company created? Of course not. And is the consideration paid in terms of shares? It's paid in terms of shares also. There is a contingent consideration. There is a cash also. So I would not say that it is mainly in shares. It is in shares. It is in cash. There are other forms of payments as well. So I don't see, looking at even the exchange ratio which was given, I think 1 share for every 2 shares, I guess. That was the exchange ratio, I think. Yes. So considering that 1 share issued for every 2 shares, I guess we can conveniently say that H is the accounting acquirer.
Yes, sir.
Right. So now I think it's time to go on for the step number 3A and step number 3B. So let me organize the input clearly. 3A. So we're going to look at all those assets and liability whose book value and fair values tax base will be different. So let's organize the assets and liability. So we'll look at the fair value, get the tax base, see what is the difference, taxable or deductible, and get the DTA or the DTL as the case might be. Okay, so I think first let's organize the input on the deferred tax implications. So we'll make a scrutiny in terms of things. Let's take the items. Let's get the carrying amount, which is equal to the fair value. Let's get the tax base. Let's see whether it is a taxable or it is a deductible temporary difference, and whether it results in a DTL or it results in a DTA. And for which I think the tax rate is given, I guess, at the rate of 30%. Okay, so let's, I think, pick up item by item for all those items where the differences are there between the book values and the tax base. So I think at the very start, I am given. You want me to show the question, or can I directly pick up the information if you have the question in front of you?
Sir, please show the question as well, sir.
Okay, I think I'll do that as well. Let's, I think, show you the question also. Let's go back and just have a look. Then we'll just fill in the blanks. Okay, so I think let's start the inputs in terms of comparing the assets. Can I say as far as PPE is concerned, definitely resulting in what? DDL or a DDA?
Because the tax base is book value is 40 crore, fair value is 90 crore.
In a way going to be a tax base, and this is going to be in a way a carrying amount. The carrying amount is greater.
DTL.
So that becomes
DTL, sir.
DTL. That's right. We'll organize.
We need to bring down.
Right.
Yes, sir.
And same as goes with the concept of intangible assets as well. Can I say that would also result in a DDL?
Yes, sir.
And then we've got investments. Investments in this particular case, again, has got the same status. Can I say that would also result in a DDL?
Yes,
Inventories are same, trade receivables are same, and there is a cash which is held in the functional currency. I don't know. I think this seems to be a little misprint to me, but I think this should be 4. I don't know if it is that way, but I think cash cannot be resulting in a deferred tax in any case.
Sir, in study mat, it is 4 only.
Okay, so I think it's a misprint when I copied this. So this is 4. Sorry, this is a misprint. Okay, and then we are given there is an NCA which is held for sale. So is that also?
Sir, I think you consider that 4.5 because it's given in the adjustment that the fair value less cost to sell is 4.5 crore for the asset held for. Okay.
The fair
I
value less
confused.
cost to sell is same, I guess.
Yes, sir. Yes, sir.
So what's the value given for the NCA in the balance sheet as well?
Right, sir.
Study mat, is it given for?
No, sir. In study mat for NCA held for sale, it is 4.5, 4 and 4.5.
Okay,
so
but then I think that, yes, but there is something mentioned about the NCA on the additional information resulting in deferred
yes,
tax,
sir.
I guess.
Yes, no. The NCA is held for sale is measured the fair value amounting to 4.5 crore.
Okay, anyway, so that's point can be left. Okay, so this is one input. Then let's have more insights on the other one. Financial liability borrowings is same, trade payable is same, provision for warranties all the same. So I think all this will not result in a deferred tax implications, right?
Yes, sir.
Anything else which will lead to a calculation of the fair value, the deferred tax implication? Can I say one is going to be the contingent liability, I guess?
Yes, sir. Contingent liability, right? 0.5.
So now in this particular case, the question is, what about this income tax demand? Are you considering this as a part of the deferred tax calculations?
No, sir. It's clearly mentioned in the notes to the other information that it will not lead to any deferred tax.
Wonderful indeed. So we're going to consider that 0.5 as a part of the calculation. Is there anything else which is there in terms of deferred tax? Even the customer relationship will not result in deferred tax. So that's also clearly given that no deferred tax implications will arise because of the customer relations as well. I think that's it. These are the only items to be taken. Let's now
Yes,
further begin.
sir.
Okay, so let's take the items one by one. So we've got, I think the first item was a PPE. What was the fair value of the PPE?
PPE
So
90 crore,
90 crores. And the book value, which is the tax base, is 40,
40,
resulting in a taxable temporary difference. I'll put it as TDT.
50.
And this will give me a DTL 30%, that is 15. Okay, the next item which we had was, I think, the intangible assets.
Yes, sir.
And that is, I guess, book value was to the extent of the fair value was, I think, 30.
Fair value 30, book value 20.
So this is 30. The book value becomes the tax base. So this is again 10 taxable temporary difference. And this is 3. That is deferred tax liability. The next, I guess, was supposed to be the investments, where I guess the fair value was to the extent of 350. The book value becomes a tax base, and the difference is 250 again. Taxable temporary difference, 30% would mean 75 is the DDL. And I guess
Yes,
the only
sir.
other item is the contingent liability.
Yes, sir.
So
We have
this
the
has got a fair
fair
value
value.
0.5. The book value was
Tax
0.
was nil.
So this is 0.5. Taxable or deductible in nature. The book carrying amount is greater.
Detectable,
That's right.
detectable in nature,
Is deductible
DTA.
temporary difference, a DDA. 30% would mean, I guess, 0.15. So let's
Yes,
see what
sir.
is the net deferred tax asset liability. That is step number 3A.
It's a totaling 92.85, sir.
That's right. So 92.85 is the net deferred tax liability based on this step number 3A. Okay, so this is one input's done. Then I think we can go ahead and have a look in terms of step number 3B. What is the list of the net assets, including this deferred tax calculations as well? So let's organize step number 3B. So we need to now organize the list of the net assets at a fair value.
Yes, sir.
So first, we'll start looking at the balance sheet. I guess I'm just keeping the balance sheet in front of me. Let me start picking up the items at a fair value directly out here. So I think we can just start copying. If you have the question in front of you, you can start giving me the inputs. I think the property,
The first,
plant, equipment is 90.
yes, sir.
Intangible assets, I guess, was 30.
30.
And there is investments
Investment.
at 350.
Yes, sir. Inventory is 20.
Inventories is 20.
And trade receivable 20.
Trade receivable is also 20. Then I
Cash,
think there is a cash 4.
yes, cash for non-current asset held for sales. That is only 4.
That is also 4.
Why
And I
we are
think that's
taking
it on
4?
the. Yeah. No, I
Yeah,
think that.
see here
Yes,
it is
because you
mentioned
can't
as a
take the fair value.
4.5.
Yes, you
Yeah,
can't
no, no,
take the
no. We
fair
should
value.
not consider fair value because the fair value less cost to sell only we need to consider.
Correct, correct. So that fair value less cost to sell is 4 and the fair value is 4.5. That's right.
Yeah, 4 we need to consider.
Yes, because we need to consider that at a book value itself. Absolutely. Now, is
Yes,
there
sir.
any other item which is not in the balance sheet but is to be considered as a part of this list?
Yes, sir. We have indemnification of asset to the extent
Yes.
of 1 crore.
Wonderful indeed. So we've got indemnification assets, and the indemnification assets will appear as a part of this list. That is like an exception. So I'm putting this in a circle just to indicate that this was one item not a part of the acquiree's balance sheet, but is certainly going to be a part of the list of net assets. Let's get the total net assets at this stage.
Take it 1 crore, no? But
Yes,
1 crore.
it is
yes, 1 crore.
0.5.
These figures are all in crores.
No, no. My question is contingent liability is
No. We did not consider the second contingent liability as a part of deferred tax calculation because there was no implication arising. But the fair value of the liability is going to be 0.5 and 2, both 2.5. So indemnification is definitely within that limit. Right. So this works out at 90 plus 30 plus 350, 40, and this is 8 plus 1. I think 519.
Yes, sir. 519.
Right. And then we consider the book value of the liabilities. So let's see what is the liabilities now.
Liability. Borrowings. First items is starting at borrowings.
So first is borrowings. That is all at the book value. There was no differences.
Yes, sir. No differences.
So that is 20. Trade payable is 28. The next item in the balance sheet is supposed to be the trades payable. That is 3. Provision for warranties 4. So next item was provision for warranty is 3.
Current
Provision
tax
for
liabilities.
warranty is 3.
Current tax liability 4.
Current tax liability is 4. So I think that's it. Nothing else is there in the balance sheet. Anything else which is not in the balance sheet of the acquiry, but is
Contingent liability.
assets?
DTL,
Yes, one is a contingent liability. Anything else? DDL?
DTL,
DTA, sir.
Yes.
DTL.
DDL in step number 3A, which we have calculated. So contingent
Yes, sir.
liability is going to be 2.5. And the deferred tax liability, which we have taken in step number 3A.
Yes, sir. Contingent liability we need to consider because 2 plus 0.5, right?
And this is 92.85. That is a DDL in step number 3A. Okay, so that gives us a list of the net assets. So looks quite huge and technical, but at the end of the day, if you're proceeding sequentially step by step, I don't see much challenges in terms of doing bigger questions as well.
Yes,
So
sir.
519 minus 48 minus 7, 2.5, 368.65. Correct.
This is
sir, why
coming.
will you not consider that? Like there
Sorry?
was an additional liability, na, that was 22 crore, then it became 23 crore. So will we consider that on 31st March and not on 1st January?
No. That is a measurement period concept. So that is a contingent consideration fair value. So that is
Yes,
not
sir.
a part of the list of net assets. That would be an updation of the CC, not net assets.
Yes, sir, got it, got it.
I think that will be part of purchase consideration.
Yes,
Not
but
here.
we take PC, contingent consideration fair value on acquisition date. The fair value change from the acquisition date to the balance sheet date is a part of 109 accounting. Okay, so now I think we can go to the step number 4 as well. So let's have a look at the step number 4, which is on the calculation of the purchase consideration. With that, we can also, I think, NCI and goodwill can also be done. Then I think more or less we're done with the question. I was a little apprehensive whether we'll be able to do that in the time frame or not. Okay, so let's, I think, begin with the inputs. We've got, I think, now 2 things. Can I say we need to consider, first of all, the PHI, and then we need to
Yes, sir.
consider the fair value of the shares issued. And we're also given, I think, cash as a part of the purchase consideration. And there is also a contingent consideration in the shareholders' capacity. So 4 elements to be considered in the PC. Let's go to the PHI. So how many shares were acquired as a part of the previously held investment? 15%. So what is the total shares in the balance sheet of the acquiry? It says it had issued 1 for every 2. So what is the total number of shares in the balance sheet?
It's a 12 crore. 12 crore divided by 100.
So we've acquired 15% stake in the company, right?
Yes, sir.
So-
First 15% stake.
Right. So we have got, what is the total number of shares in the balance sheet? I'm just trying to locate that.
Sir, 12 crore divided by 100.
So face value is 10, 100. So there is 12
Yes.
crores is the total value. So we've
12
acquired
lakh shares, sir.
50%. This is the number
12
of
lakh.
shares acquired.
12 lakh
That's number of
shares.
shares. Yes, number of shares acquired. And what is the fair value of the PHI on the date of acquisition? What is the value of the share? I think on January 17, the share is 395 each.
Yes, sir. It is given in the other information. The quoted
Yes.
price of the equity shares is on 1st January is a 395 per
70.
share.
Absolutely. So this is the percentage stake, or we get the number of shares into the fair value on the
Where is 12
date of
crore?
acquisition.
Sir, where was 12 crore given?
I think somebody just gave me that. I was still trying to locate. I think I was
Sir,
asking where is the
sir,
total. Yes.
sir, 12 crore is a number of shares divided by 100. It will come 12 lakh shares.
No, I'm just trying to locate where the 12 crore is. It's in the balance sheet, right?
Yeah, you see, if you look at the balance sheet, the carrying value of the value is 12
Correct,
crore.
correct. I
12
think
crore
somebody
divided by
was asking me.
100.
Yes, yes. Somebody was just asking me where do you get the number. So let me just show him the number. Since it's a big question, you need to go back and keep locating the information. This is the 12 crores and the shares is 100 each, right? So we get the number of shares, 12 crores divided by 100 and into 15% stake and into the fair value per share.
Yes, sir.
Okay, that's great. So let's see what is the value coming to 12 crores into 15% by 100 into 395. I think it's 7.11, I guess.
Yes, sir. 7.11 crores.
Wonderful indeed. Then there is a fair value of the shares issued. Can I say now in this particular case, we've acquired, can I say out of the remaining 12 crore shares, so what is the percentage stake acquired?
45 percentage.
45 percentage and divided by 100 to get the number of shares. So we said
Yes,
we
sir.
issue one share for every two shares. And what is the value of the share?
Sir, value of the shares,
We
if you
issued the shares. What was fair value of the acquirer?
fair value of the equity share of the Hutch
10,000.
Limited, 10,000 per share. It is given in the
10,000.
other
So that is the
information.
value of the shares. That's right. So we
Right,
have
sir.
calculated the number of shares acquired in the acquiry. We issued one for every two shares at an issue price 10,000 per share. So this is 12 crores, 45%. And this works out, I guess, at a total of 270, I guess.
Yes, sir. 270 crores.
Right. So I think before any confusion sets in, let me make it clear. This is the fair value of the acquiree. And this is the fair value of the acquirer. Because this is what we are considering the number of shares issued in the acquirer into the fair value of the acquirer. So I think let me just pinpoint so that later there is no confusion. This is the fair value of the acquiree. And this is the fair value of the acquirer. Because PHI is based on the number of shares held in the acquiree into the fair value of the acquiree, and the fair value of the shares issued is the number of shares issued into the fair value of the acquirer. Okay, next we are given as a part of the consideration, there is, I guess, cash. So we paid, I think, 50 crores of cash directly given in the question.
Yes, sir. On 1st January, Hutch Limited has paid 50 crore in cash.
Correct. And the contingent consideration has got a fair value on the acquisition date. I think that's also directly given 22 crores. Updation will be taken at a later stage. So I think that takes care of the step number 4. So 270 plus 50 plus 22 and 7, I think it's 349.11. Right, so I think we've managed the step number 1 to step number 4. Let's also then do step number 5 and 6. Then I think for the measurements is not a big deal. So let's now go to the step number 5. That is NCI. So the next is the step number 5, which is the calculations on the NCI. NCI is very clearly stated in the question. We are taking at PASNA is very clearly said in the requirement. We are taking a proportionate share in the net assets of the company. So can I say in this particular case, the net assets is already calculated in the step number 3B, and The total stake acquired by the parent is 15 plus 45, 60. So the NCI gets a 40% stake. So what is the net assets in the step number 3B? 368.65. So net assets is 368.75. 75 was it? 65.
Yes, sir. 368.65.
So 368.65 is the net assets.
Yes, sir. 65.
And the percentage which is held by the NCI is 40%, considering 15 plus 45%, 60% goes to the parent. So 40% becomes NCI on date of acquisition.
Yes,
147.
sir. It's
Yeah, one
147.46.
right, 147.46 is the NCI as well. Okay, and then finally, we can calculate the goodwill as well, which is simple, organizing the data. So let's go to the step number 6 in this case. And this case is not a case of common control or reverse acquisition. So you can put the 7th entry as well. That is the case of acquisition entry. So let's now calculate the goodwill or the bargain purchase gain. We take the purchase consideration at the NCI, compare this with the net assets on date of acquisition, and we get the goodwill. So let's first take the purchase consideration. That is, I think, 349.11.
Yes, sir. 349.11.
Right, NCI is 147.46
Yes,
and
sir.
net
Just
assets is
calculated.
368.65.
Yes,
That will
sir.
give us the goodwill. That is 496.57. 127.92. The difference we're getting is, well, so I think all the 6 steps are done. We'll just organize the entry as well. Since we've done this, then I think let's give it a finishing line. Let's
This
do the step
is
number 7
partial
as well.
goodwill, now, sir.
Sorry.
Since it is E by H, it will lead to a partial goodwill, now, sir.
Yes,
Consideration.
yes, that's right.
It's not
That
a full,
doesn't
full,
make a difference,
full
but you're
goodwill.
right. Since it is Pasna, it is a partial goodwill. You're right. Then let's organize the step number 7 as well. Let's organize the data in terms of the acquisition entry as well. So that is nothing but connecting all the steps what we have done. So I'm not putting the detail of each and every net asset. Let's directly take the net assets and consider the purchase consideration, consider the NCI, and also get the goodwill. Everything is already computed. It's just putting them all at one particular place. So let's see what was the figure of net assets. 368.65. The purchase consideration is 349.11. The NCI is 147.46. And the goodwill is 127.92. Undoubtedly, the entry should tally, but you can still make a check, though there is no way it should not tally because we're just picking up all the figures from the previous steps itself. But still, just in case, let's still check it up. Yes, it's perfectly matched. So that takes care of one aspect. The question is not fully answered, but we have taken care of the acquisition accounting. Now the only thing is the updation of that contingent consideration and also the updation of that customer rights and all. So I think let's put some entries relating to that as well. So I guess we can first consider the entries pertaining to the contingent consideration. So can I say, as far as the contingent consideration is concerned in the shareholders capacity, so there is an increase in the contingent consideration. So P&L gets a debit and the contingent consideration gets a credit. So I think that was to the extent of 1 crores, I guess. 22 to 23 crores, I think. right? So that 1
Yes, sir.
crore difference enters in the profit and loss. Now we also going to consider that customer relationships as well, because we did not record that asset. So now it is to be recorded. And is this going to be a part of the measurement period concept, impacting the goodwill as well as the NCI? Am I right?
Yes, sir. Yes,
Correct.
sir.
So this customer relationship, the fair value was defined. What was the fair value of this particular thing? I think on the date of acquisition, it was 3.5 crores, right?
Yes, sir.
Resulting in the
3.5
deferred
crore.
tax implication. So we will record that customer relationship. Let's put it as CR. That's 3.5. So what do I credit at this particular stage? Can I say
Sir,
goodwill as well
Both.
as NCI 60/40?
Both.
yes, sir. To the extent
Correct.
the NCA to the extent of 40 percentage,
Yes,
goodwill to the extent of 60 percentage.
absolutely. So goodwill will be 60% and NCI will be 40%. So let's take 60/40, 3.5 in that ratio. So I think that would have answered all the questions, I guess. The point number A is done. The point number B and C, everything is done. All requirements done. Wow. The 60% would be 2.1 and 40% will be 1.4. So that is the entries which are done, you can say post business combination. So all these entries are done in the post business combination period. Well, I thought maybe we may not be able to manage this question in 1 hour, but I think we managed it. So it was looking huge. Took us almost 25 minutes to read and almost like another half an hour, 35 minutes to do, almost like 1 hour. But I think it's a wonderful question on the concept of acquisition accounting.
Sir,
That was a,
based on the consideration of time, the marks should be allotted for this 30 mark instead of 14 mark.
there's no question which comes in the exam for that many marks actually. Anyway, I think that brings us, to the end of the entire concepts of business combination. So we have covered the entire concepts as well and done questions on acquisition accounting, reverse acquisition, as well as on a common control transactions as well. So now I think you're ready to, do all the questions from this area, practice as many questions as you can on business combinations, because in the next session, we're going to start with the aspect of consolidation with you. So now the next trail of standards that is going to be Indies 110, then Indies 28, Indies 111. All these standards will be in the chain. I think we've got almost like, I think 5 classes or so allotted to all those areas. So I think we're going to do good practice. So we'll maintain the inputs in terms of first getting a quick revisions on the concepts and then doing questions with you as well. I'm definitely planning to do a lot of questions on Indies 110 practical kind of questions. Typically, if you look at those recent kind of questions which have come in the exams, where there has been a concept of step acquisitions and all, wonderful questions indeed. So now the points which are getting is getting interesting. Though I have a very interesting question also with me, but it's too much. I don't know if I'm doing that or not. But I have a question, which contains the impact of deferred tax implications also. It's actually a wonderful international question. So what do you want? You want me to do one of that particular questions in the coming sessions? Say no.
Yes, sir, we will do it, sir. If your time permits.
No, we can, but it takes a little time. I think that question itself, what I've done earlier, takes at least around a 1 hour to 15 minutes or so. So almost like 1 hour, 15, 20 minutes to do that kind of question. But I think the level of clarity one gets in terms of those steps is big. Because I again follow the concept of 7-step model. So let's see if time permits. I think maybe we can do that kind of question, because this is one good question on 103. Similarly, there is that one kind of question which is not an examination question, but it is basically a question picked up from the foreign exams, but it's wonderful treat to solve. Anyway,
Sir,
so over to you, friends. Yeah.
yeah. If not time permit, we can discuss the each point, the clarity, how it should be solved, where it will fit. Like that, we can have a discussion.
Okay, no problems. That is well taken. But I'll definitely try to do that question. I think I'm in a good mood to do that. So we'll hopefully do that question in the class.
Thank you so much, sir.
You're most welcome. So any questions on your side, friends? I think we're done for the day. The business combination standard over. Any questions on your side? Okay,
is
so I
there
think that seems to, yeah.
anything,
Sir,
I read it, there is a concept of partial goodwill and full goodwill. Does it impact anything? I mean, like if we are doing
It doesn't affect Index 103, but it definitely affects Index 110. Like, for example, as a part of the adjustments in consolidation, we'll be discussing the impairment adjustment. So basically what I'll do when I'll come to consolidations, I'll give you certain set of adjustments. One of them will be goodwill impairment. So we'll see that if goodwill is partial, how does it get impacted in the consolidation? And if it is full, how does it get impacted? So that part will be taken care. But yes, it definitely makes an impact on the
okay,
consolidations.
okay, okay.
So don't worry, we will be covering that in the consolidation part.
Right. Thank you.
Thank you. Right, friends. So I think that seems to be good for the day. Then it's time to bid you goodbye, friends. See you in the next class. Thank you. Bye bye and take care.
Thank you,
Thank you.
sir.
thank you, sir.
Thank you, Vita. Thank
Thank
you
you
very
so
much.
much, sir.
Thank you very
Sir, have
much.
a wonderful day.
Thank you very much indeed.
Okay, thank you.
Thank you.
Anji, thank you. Same to you.